what it had been like previous, so stay with me till the end of the event. तीन चीजें मैं इसमें आपको बताऊंगा which will help you in knowing what should you do in case of the Russia and Ukraine conflict. So पहली चीज जो है इसमें जो हम आपसे बात करना चाहते हैं, that is about the war puzzle. War puzzle is a very beautiful and important concept that is related to investment portfolios when the war is happening. The second is the safest havens where the money is actually going on. And the third is investor traps. Traps that you should save yourself from falling into. तो इसमें आप stay tuned रखिएगा because कोई भी चीज़ अगर आप इस पर छोड़ देंगे you will be missing out on the critical elements and which will help you in all your future decision making capabilities also. So without wasting much of the time, it will be a crisp 10 minute session for you. So here we begin. So first and foremost, the market crash has happened, and now the question arises among that in this COVID or post-COVID and the Russian-Ukraine conflict, what your actions should be like. So here, let us see where the markets are currently. Here we are seeing the market crash has happened, and from the 18th October high, as we are seeing the 18th October high, we are already down by around 9.7 or 10%. So 9.7, 10%. Now, first thing and foremost, it is not a market crash. Market crash happens, or you can say the recession when we say that happens when it is over and about 30%. The 30% fall nahi hua hai, to recession hai nahi, so we are knocking that thing off. So now let's come on to this section. Now we are coming on to the point. Market crash has happened because of the Russia-Ukrainian conflict and the inflation numbers that are present into the market. So these are the two broader things that we are looking at. Now, inflation thing has been going on quite a while. Now, because the crude has also hit an all-time high in the recent past of around $95 a barrel. So उसे है कि inflation और बढ़ जाएगा, हमारा agri business या wheat या maize या barley बहुत महंगा हो जाएगा. Now, before we proceed further on that story, let's first see. Historically, whenever the global conflicts have happened, whether it is a Iran-Iraq war or Korean or so on and so forth, how the markets have performed and what impact it had actually into the market. Because from the historical figures, we will also see, are we somewhere different this time or it's more like the same. So here is some facts that I am bringing on to you. So how modern stock market is affected by war. So here if you see the table, these are all the market shock events. Starting from the Pearl Harbor attack to Iranian general killed in an airstrike. So it is from 1941 to 2000, and if you see when all these events, whether it is a US terrorist attack or an Iraq invasion of Kuwait or the Reagan shootings, anything you call about, maximum one day fall had been around 4.9%. Here if you could see, and here 5.4%. The 5.4% had happened in a single day fall in 1950 when North Korea had invaded South Korea. And if we see around 4.9, that is a 5% fall. That was when the US strike had happened at the World Trade Center, US. Now, the total drawdown figures, if we see, the maximum drawdown of around 17% had happened when the Iraq invasion of Kuwait had happened. This is S&P Dow Jones जो हम कहते हैं. And on an average, if you see of everything and anything combined together, averaged maximum fall in a single day has been 1.2%. Total drawdown because of any such global conflicts have been around 5%. Number of days in which the bottom was hit, that was 22 days. It took 22 days to hit the rock bottom on an average, and from there it took around 50 days to claw back or have the recovery. These are calendar days. एक महीने में nearly 22 calendar days हो सकते हैं. So we can say that in normally 22 calendar days the market had recovered. So this, if you see from all these factors, any of these global conflicts doesn't have any knee breaking or any such fundamental impact on the global stock portfolio for that matter. So therefore, at an onset, I would like to tell you, you don't need to be worried about the Russian crisis. Inflation is the concern, but that is being taken care of. The rate hike is expected. So this is called as a war puzzle. Now the war puzzle says the market correction has been seen before the actual war starts. So that means whenever the market corrects, the maximum of the correction happens only preceding the war. And once the war starts off, then the market goes for a bull run. So during the time when the war is being fought, whether you talk about the World War II or any of Iran-Iraq war or so on and so forth, when the war starts, the market is on the positive trajectory. But before the war starts, it corrects a bit. So what you have been seeing is like before a war thing, and we are quite confident that the things will be taken care of and that de-escalation would be there. But even if it happens, it will be good for the market. The market will anyways goes up, because this is what the statistical figures and the historical figures show, that it is called as the war puzzle, and many of the economists are quite not sure why it happens. Now the second thing that comes, capital market performance during the times of war. अब war start हो गया है, okay, war start हो गया है. Now ये बताता है कि if you see whether it's the World War II, Korean War, Vietnam or the Gulf War, if you see the Gulf War, this is something you can quite relate to. In terms of the large cap stocks, they had seen 12% upswing returns with 19.4% of the risk. Then if you see the small caps, it was minus 1.2% returns with 30% of the risk. 12.5% returns in the long-term bonds as compared to, because the money will go on into the bonds. This I will cover later on in the safe havens section. So therefore, if you see broadly, everything has been positive except one of two figures, this and this. The only concern this time is when we talk about all wars and exactly the risk, the inflation numbers at that time were around 4.5 to 5.5%. Currently, it is around over 7% in US, which is around highest of the 40 years. That is the only thing. But for US, it is not a big deal. They can keep on printing the money, like $19 trillion they actually printed in the last 2-3 years, so on and so forth. So this is the matter of fact. So therefore, even during the war, there has been a bull run across. We have seen that. So now what is the catch? The catch is currently the inflation, unless and until the RBI and all these things don't increase the rate of interest so that it will taper down the curve, realistic valuations of the stocks will come, and from there the market will again see the recovery. So if we see the Russian-Ukrainian war, the money is actually, there are the three things that are being impacted: natural gas, oil and natural gas, grains and wheats, and safe havens. So when the money is exiting from the stock markets, where it is going? Do you think the money is going in US dollars, invested into currencies, or it is going into cryptocurrencies? Where it is going? 99.9% of the investors don't know that it is the Swiss franc. Swiss franc is actually the safest currency where the money flow goes whenever the market corrects. So it goes into the gold, it goes into the Swiss franc, and it goes into the government bonds. So in December, when we had seen that government bonds and long-term bonds had taken a quite burnt, this now will be quite helped by the outflow of the money from the equity markets into the bonds, into the gold, and into you can say the Swiss franc as a currency. And if you see the Swiss franc here, from 2015 till date, this is one of the best performance. It is at the highest level. It is at the highest level. It is nearly at the highest level if we see from 2015 onwards. And here if you see the agri-business soaring food prices, the food inflation is going on, because if in the European peninsula and Russia and Ukraine, if the war breaks out, it will again, already inflated prices will go a bit higher as far as the grains and wheats are concerned. And then there is a natural gas and oil that we can obviously say, because there are pipelines from Russia to the rest of the Europe that goes on, and if Russia closes the tap, then obviously that will be an issue. Now here comes the main graph. Now there are different asset classes. Sensex का जो आप यहाँ देख रहे हैं, this is Sensex at around 8.6% negative returns. Here it is Sensex 8.6% negative returns. And if you see here, we have US 10-year bond yield going high, crude going high. Now here you see gold. Gold is now around 5% up. Silver is around 1%. And then you have all these things in Japanese yen and so on and so forth, which is also called as one of the safest currencies to park funds into. Now, the matter of fact is, when we were rebalancing our clients' portfolio quite 6 months back, a half year back, we had been quite vocal about the things. Kindly invest into agri-business fund, global commodities fund, so on and so forth. And all those funds are actually the one which will be benefiting from the conflict, because the commodity prices will go high, the energy sector will go high, and so on and so forth. Now, the only thing you need to be worried about, because of the ban by SEBI, investment into great consumer fund of Mirai Asset, which is a global fund, global agribusiness fund, world mining fund, have actually been stopped. But the SIPs which are already running are continuing, so it is highly recommended that you keep continuing those SIPs. SIPs should not be stopped. STPs में issue होगा, but STPs ठीक है, STPs you can relocate to anything, but if you are buying it out, do those allocations, because that will in turn help you out. Now it brings us to the last session of the quick session, which is be aware investor, don't fall for these traps. Now, as an investor, this global conflict has come and now you are quite worried about how the markets will pan out and how the things will happen and what you should be doing it. Now, whatever you decide is actually based on different biases that you are actually having. So here we are talking about recency bias. So there are the 5 traps that any investor falls for. So before you take any decisions during this turmoil, just reflect upon yourself if you are getting trapped into any of these biases. Recency bias. Recency bias means you are taking a call based on your recent memory or things that have happened recently. So that means from 18th October till now, in the last 6 months, markets have been correcting and going down. So what you will be doing? You will be thinking कि भाई stock market में पैसा नहीं बन रहा, I am not able to make money in the stock market, so let me sell all the stocks, let me get into bonds, let me go into that. Now, however, if you take a call now, you are already 10% down the high. And if you're exiting the stock market at this time, you're already exiting it as a discount. You will never be able to make money for that. So you will be booking your losses as of now. And then when you are entering, you will be going into bonds, which will not give you that much of the returns because they will be taxed when you exit, and that too decently. So therefore, you have not made money here and you have exited and not made money here. So therefore, your allocation has to be based on a strategic plan that you have set for the next 1 year, 2 year. And the deployment has to be based on the scientific principle, whether you want to participate in the India growth story by way of the focus areas where the government of India is investing into, because much of the investments is not going to happen through corporates, but it will be happening through government. The government will be doing the capital expenditures and not the corporates. If the government is doing the capital expenditure, it will go into infrastructure, it will go into Gati Shakti program, it will go into Bharatmala, it will go into Sagarmala, so on and so forth. So it will go into defense manufacturing. So you need to identify the sectors where you should be putting your money. You can be going into commodities, or you can be going into consumption driven funds, or in Indian specific funds for that matter, rather than taking a call just because the market has corrected in the recent past. The second thing comes about the anchoring and adjustment bias. Now, anchoring and adjustment bias क्या होता है? You get anchored on a certain notion. For example, 2 examples of anchoring are: you had invested into a stock at $100, it went to 150 and it came down to 130. You can still book 30% profit and come out at 130. But आपने देखा कि भाई वो it went from 100 to 150 and came back to 130. Now you want to sell it, but only at 150. Even if the fundamentals would have changed. So therefore, if you have any stock in your portfolio that was benefiting earlier from the low inflation numbers, that means capital intensive stocks, those stocks which or companies which had loans on their books and the lower interest rate was in benefit to that, and now if the RBI increases the rate of interest, which eventually it will, so therefore your portfolio will be at a loss. But you will be anchoring on to it because you think कि नहीं इसने all time high इतना किया था, वो उतने पे जाएगा तो मैं निकलूंगा. So therefore you need to have an objective assessment of looking into your portfolio before you take a call. So that is called as the anchoring risk. Second comes the availability bias. Availability bias means now this decision has happened, this event has happened. Russian-Ukrainian conflict has happened. Now you are having a talk among your golf peers, among your buddies, among your office spaces. Yeah, मेरा portfolio down 10% है, मेरा 20% है. And now you will be basing your information on the easily available information to you, which might not be the right, but maybe the convenient source of information. So you would be doing it from the TV, you will be doing from the friends, from the social references, so on and so forth. भाई मैंने HDFC का top 200 ले लिया, तुम कर लो, या मैंने बेच दिया, you also sell those things out. Having said that, you will be easily falling for the easiest way to take a decision. So therefore, you will be falling for around 4 factors. First is retrievability. anything you can retrieve easily from the top of your mind. Now you will be thinking that, okay, in 2010-11 I had lost money in infrastructure fund, so therefore I will lose money now also, so therefore I will not invest in infrastructure fund. When the matter of fact is, between 2020, 21 or 22, the infrastructure funds had outperformed the large cap funds, where the infrastructure had given from April 2020 to 2021 around 80% return, when the large cap funds on a broader parlance had given only 50 to 60% returns. But since your last memory had been easily कि भाई मैंने infra लिया था and infra was not doing good, that is the reason why you will not be buying into it. Categorization. You know that, okay, I want to invest into large cap and the mid cap and small cap, but you will not be knowing that there are better and efficient categories to invest into. Say for example, commodity funds or global index funds, but those commodities are off track. They are not top of the line categories which you might be quite aware of. So you normally judge investment opportunity by means of categories which are quite easily available and heard of. Narrow experience range. For example, if you're not having too much of the market knowledge, but you are from, say, tech background, or you are from the pharma background, so you will try to stick on to that segment rather than explore opportunities otherwise. So therefore, if you're taking a call, you need to ensure that whether you understand the macroeconomics before taking a call, just because you feel for it or you have a gut feel for it. So rather than going a gut feel for it, it is very important that you need to rationally see through research reports what call you need to see. Lastly and most important is the resonance. Resonance means if I as an investor, I am a frugal person or a thrift person, or I am thrifty, so I can't buy a stock which is quite expensive. I won't buy a 30,000 stock because it won't fit in my personality trait. दूसरे लैंग्वेज में कहूँ, अगर मुझे लगता है कि मैं चिंदी आदमी हूँ, मैं नहीं बाई करूँगा स्टॉक जो कोई महंगा, मैं कहूँ नहीं ये गिरने तो मैं तभी बाई करूँगा. हालांकि for that industry and for that stock, the PE multiples, the costing, that would be totally different. That might be totally different altogether. And for that, the higher numbers are the norm. Lastly is there, lastly हम होगा इस पे regret aversion. Now regret aversion means if you have to decide कि भाई रशिया यूक्रेन का conflict है, what I should do, you will try to do things so that you can defer or do not get regretful in future. So you will, for example, you will say कि if I invest and the stock goes down, then how much I will be regretful. Or if I do not invest and the stock goes up, then what should I do? How much I would be regretful. So in order to prevent your regret, you will be doing 2 or 3 different things. You are playing golf, and with your friends, you will be discussing कि भाई okay, markets are getting corrected. Now out of 4 after four people, 3 are saying कि okay yaar, we have sold our holdings, we are putting in cash, we will wait for next 2 months. Now you will also try to do that because you think that herd mentality, the mass have done the same, so therefore I also do it, and if tomorrow market goes the other way around and I incur a loss, then I can at least console myself कि नहीं भाई सबका हो गया, या हो रहा था तो वो हो गया, या I took a call which was, I had spoken with somebody and I had to take a call and वैसा हो गया. So this is one thing when we talk about the regression. People tend to be more conservative in terms of their decisions. So one is that herding. You, and the second objective is कि you will go for stocks which are blue chips or the brands. So if you do not want to be regretful in the future, you will buy into the stocks which are maybe the large cap or the bluest of the bluest stocks, and you are buying it. However, there will be much better and bigger opportunities available in the micro cap stocks or the small cap stocks, but you do not want to take that call because you don't want to have a regret in future. Now, if I say that in the last 1.5 months or 3 months, maximum of our returns have happened into the micro cap or the small and mid cap categories, and those profits had been booked and parked into the gold. Had it been large cap stocks, we wouldn't have got a single day 8% or 10% swing into those stocks. So therefore, just to reduce my regretfulness in future, I normally tend to be more conservative. I ask my peers what to do, so that whatever the people do, I do it. I go for big companies, I don't take action. So these are the things that happen. Now finally, what you as an investor should actually do. First thing, do not panic. You don't have to panic. And the second thing, you have to be rational. So these are the 2 things you should be doing, first and foremost. After that, what you should be doing is around 35 to 40% of your portfolio has to be in gold or the short-term debts, because those are one of the best funds into the market which to park the fund. Gold has an inherent value which you may not be able to see now, but in next 6 or 8 months when the market swings in its favor, it gives you the squeezes the returns for you. Do not stop your SIPs or STPs if you have based it on the current budget, or you have based it for the next 1 or 2 years based on the industry cycles, market, and the focus of the government. Don't stop your SIPs, and please maintain the discipline of that. Weed out the weaker stocks. Those stocks which were benefiting from the lowest inflation, lowest interest rate scenario, now shift to those stocks which benefit from the higher inflation and the higher interest rate scenario. Companies which can transfer their pricing or costing or inflation back onto the end consumer. Go for consumption driven stocks within India, so on and so forth, so that global trade and the global imbalances don't affect your portfolio. The best opportunity now is the market has got corrected by around 10%. Now you can use this as an opportunity. You can use this as an opportunity to do the tax harvesting. Book the profits on your good stocks if you have to rebalance your portfolios. Book your losses. Losses will be netted off against gains, and then whatever the capital was stuck in the loss-making stocks, those money can be freely available to be redeployed in a portfolio, so that it is set right for the next 6 months or the 9 months of the period. That has to be, and that has to be there. So now for those investors who have missed out on their 2020-21 bull cycle, this is another opportunity where you can have a mini bull cycle. What I want to say is, if Russia or Ukraine conflict wouldn't have happened, due to inflation, market was already running into a range. From October 18 to now, market was already running into a range, but due to Russian and Ukrainian issue, it has corrected, steep fall. Now if you buy or take positions at this time and it reverts to the mean, and even if it again maintains that range bound manner, you still would have made certain returns on the top of it. So invest in those companies which you would love to hold for next 5 to 8 years to 10 years. That is what my point of view is, that your approach has to be like. So this is what it is. Thank you so much. Don't take decisions. Don't take knee-jerk reaction just because you see the market and you see the anchors thumping the desks on the TV. Be rational, be professional. Just like a surgeon doesn't become emotional while doing surgery. Similarly, if you're managing a portfolio, you don't need to get volatile. I would say that, like the stock market and stocks are volatile. You don't have to get perturbed about the market, because these are knee-jerk reactions. All wars and conflicts have happened, like I have shown it. Let it pass. Just make sure your allocation is right in an order, so that you are better placed to reap dividends henceforth. Thank you so much. Thank you so much. Happy investing. This is 𝐒𝐧𝐬𝐽 signing off from Finogen.